Good morning, good morning, good morning, everyone. John's smiling. He's obviously probably been sitting up all night watching the election results. Have you over in America, John? No?
Well, that in a sense, no, because it would have been 2 nights ago. It was a relatively fast count in most places. There's a few that's still counting. So, but it was amazing to me that I listened to the BBC, the Today Show and PM, and both of those yesterday led with the U.S. election. So, I'm sort of surprised it's that important.
Yeah, yeah. Elections tend to be in most countries, I suppose, but
Yeah.
in America, it maybe has an impact on world politics. But anyway, we'll avoid world politics. There's not much worrying about U.S. elections, I'm sure, in Bristol. Ed, good morning to you. How are you?
Good morning, everyone. I'm fine, thank you. I'm safe.
Excellent, excellent.
Safe here from world politics.
The way to be, the advantage of living some rural Britain. Okay, let's get straight into this morning. Lots to get through. First of all, in case there's anyone sort of new to this weekly broadcast, we do this weekly just as a quick overview of the market. We tend to have special guests and topics, and really it's all around education, just making sure people are up to date what's happening, and if they learn some things then that's obviously a bonus. And in fact, John, last night we had a networking event, and I'm actually currently in the PLMD offices in
Hmm.
Stratford. We had an
Hmm.
event here last night, and John, it was standing room only. We ended up with, I think we had about 65 people book and about 52 turn up, which was fantastic. We had a shareholder meeting first of all for Becontree, but you can see the audience, lovely food put on, and yeah, some really good chance to talk to investors and developers, and it was a brilliant night. But a number of people sort of walked up to me, John. It was like, "Ah, I actually meet you in the flesh. I listened to your broadcast on a Thursday morning, and I actually get a chance to meet you." So that was
Cool.
quite cool.
Yeah.
Um,
Do they
so
all
uh,
say, "Wow, I thought you were taller. I thought you were shorter"? Because that's one of the weird things where they get used to your voice, and then like the dimensions of the physical person is, "Oh, you're bigger, you're smaller." So
I don't think there was any major takeaways on that. There's probably just a surprise of a face to face meeting. Probably took a few seconds to sink in, but yeah, no,
mhm.
it was brilliant. And I actually met a couple of investors on our platform, John. They've been investors for like nearly 3 years, and
Mhm.
you see a first name written, and then it's like, oh, and what's your second name? And you go, oh, so you're that person. Yeah, we've been
Yes.
communicating by email for nearly 3 years. You've invested in
Cool.
multiple projects, and great to actually meet you. So yeah, really, really good event. Hitesh actually made it up, which was really good. You can see him in the middle there. So it was
Yeah, he
excellent for the
actually
investors.
flew in from Africa.
As in, was he on traveling
He
and
did
just
a he
arrived into
did a
London?
quick business trip and had only just arrived back, so he could come to the meeting.
Excellent, excellent. So cool, cool. So anyway, that was last night. So there'll be a few things on social media, etc. But a really, really good night, absolutely fantastic, and that's what we like to hear. So massive, massive news for us today. Absolutely delighted, delighted, delighted to again talk about a project that has paid out to investors. So this was a planning uplift project. I've got the champagne cork, the champagne bottle with the cork coming out, showing the elation that the staff have today. So 50% ROI was achieved on this project in 10 months. I'm delighted that Mr. Ed Morgan's able to join us for a quick hello. I know he's under pressure for another job he to get to, but he willingly give us 2 minutes of his time. So Ed, successful project. This is now your second time paying back to the investors. So how do you feel?
Great. Yeah, I was glad that we rose to the challenge and delivered in the time frame. Wasn't smooth sailing, as it never is, but we got there, and it's a great result for everyone. So happy, very happy.
Excellent, excellent. So this was a
Actually,
Go
it
ahead,
was. I am one of the passive investors. It was completely smooth sailing for the investors.
John. I can see
Yeah,
Ed's smile. Yeah, I think that's the proverbial duck in the water, Ed. The investors saw the nice
yeah.
smooth above the water passage along the lake, but underwards, yeah, there's lots of movement. But
Yeah,
so you Ed,
we're
you
the
raised
ones drinking. So
yeah. So Ed, you raised £25,000 from platform, 24 investors on the platform. that was to pay for your planning application. So you mentioned sort of not smooth sailing. So just very, very briefly, was it like a few delays, or was there some frustrations during that, or what was it that gave you that
Uh,
concern?
well, there was the standard delays. I think everyone who's submitted a planning application in the last 2 years would know that there's extended timeframes dealing with planning applications. The local authorities are under a lot of pressure. They don't have enough resources, so there was delays in that. Um, but we also had a fair amount of local opposition, what I would call NIMBY opposition, which we had to counter, and we did. I attended a couple of uh, parish council meetings. I met with objectors. I tried to. We did make some changes. We listened to their reasonable points, and we actually withdrew the application and submitted, and that was uh, that was finally approved.
Excellent, excellent. Okay, and that in itself is a good sort of takeaway learning point. That's a little bit of compromise, bit of give and take with the local community, and you can, not in every case, but in many cases you can find an agreed way forward. So, obviously the return on this, Ed, you're able to pay back to the investors, 50% return on investment, which is an eye-watering amount. I would just remind people this was a planning uplift project, so it is a high-risk investment. If the planning application had failed, then the money was gone. So you have to obviously balance risk with reward. But the average in investment amount across the 24 investors was just over £1,000. So there were some with more than that, and lots at 100, £200. So, John, a great way to sort of dip an investor toe into the sort of crowdfunding market, and you can put £100, £200 on a project like this and just see how it goes.
Well, it's a great way to test out Ed and his team, in the sense that if I put £100 in, I get to watch what they do. I get to see how well they communicate. I get to understand what the shareholder agreement is all about and all the rest. If you put in a bit more, that's fine. But I like to say, if someone has only £1,000, they can buy a course, or they can invest in 10 different deals and learn about 10 different projects and 10 different teams and things like that. And part of this is maybe then you reinvest your profits, or take that £100 when you get it back, if it's positive, if it's successful, and you can put it in the next phase, it's the next project from the same team. So it's first date, second date type analogy.
Brilliant. Okay, and Ed, just before I let you go, you're actually now moving to actually build the single dwelling property that you achieved planning for, and you have a second raise with this Church Road project on the platform now as View Deal. People can go, they can look at the pitch pages, they can download the equity offer document, they can go to the forums, ask questions. But I'm sure you're excited about getting on now and actually being able to raise the funds to build this unit.
100%. Yeah, I mean that was always the end goal, was to develop this fantastic property. Yeah, I can't wait. Let's get on site and build it out. That's what I say.
Yeah, no, looking forward to it. I was actually on a site visit, and it's a beautiful site, fantastic views. So listen, Ed, I really appreciate you joining. John, just wrap up this section before we move on. This is very much one of the beauties of crowdfunding, where you can actually, there's obviously different stages in property of planning to build to income, but yeah, a developer can actually use crowdfunding for different stages of the process.
It's very true. In fact, there was a question that I'll address at the same time. So the original fundraising was for planning. It was called Planning Uplift, but it was essentially just for that phase, and those investors will be exiting. If they want to come back around, they can do that by investing in this next phase, or they can move on to something else. Those that just wanted to try out Ed can definitely do so. And those that wanted to just do planning can move around to other planning applications, other planning projects. As a developer, though, it's also an inexpensive way to build your audience. And I say inexpensive in that you're offering an eye-watering rate of return in the planning uplift phase. But essentially you're only raising a small amount of money. And if you're successful with that planning change, then you'll have more than enough margin to afford to pay that return. But now you have a semi-warm audience who might be interested in the next phase if you choose to go on. But you're not committing yourself. You can actually sell off the site with planning, or you could choose to build it out.
Excellent. Okay, well, listen, we need to move on, Ed, with the rest of the broadcast. So thank you very much for joining us. It was good to have you on. It's always great when investors choose to invest and it goes well. And yeah, 50% return on investors is an excellent result. So congratulations to you as the fundraiser, and wish every success for the next part of the project.
Thank you, David. Thank you, John. Take care.
No problem at all.
See you.
Thank you.
Bye.
Okay, so just a very quick update on some other projects. We've got Stafford Gardens, which is actually another planning uplift project. It is currently view deal in the platform. So again, you can download the equity offer document, and on the right-hand side there, you can see how you can leave an email address and leave an amount you may be interested in investing if this is something that interests you. Yes, John?
So someone was asking, how does the money get spent in a planning uplift project? You need to look at each of the individual offer documents. They tend to detail where the money they intend to spend. It's not guaranteed it'll get spent each of those line items, but you know, whether it's planning consultants, application fees, studies for BATs and things like that. There are a number of planning uplift projects that have already taken place. And if you register on the Leo site, you can look at those documents and you'll start to understand.
Yeah, and that's one of the things we look at, John, is to make sure that there aren't additional costs just being sort of thrown in under the guise of planning costs. It has to be costs that are obviously attributable to the cost of the planning application. That's obviously vital. So, okay, so again, you can have a look at that one, which is fine. And then we are also talking about Becontree Avenue. We're actually in the building with PLMD here currently, and they're Tranche 2 of Becontree Avenue is on the platform as well, currently view deal. And you can go on exactly the same, download the equity offer document, have a look at the forms, get all your questions answered. And for this one, actually, John, it goes live today at 12 noon. So this one is live today. So if it's one that you've already recorded your interest on, or you're thinking you would like to pledge on this one, it is live for investment at 12 noon today. So it'll turn the thumbnail will turn to a green color rather than the current blue color of view deal, and you'll be able to actually then click and click on through where the red circle is here and actually make an investment if you so wish. This is a second tranche of an income product. They've already actually paid out 2 dividends above their projected ROI. And they're now raising 180,000 of further equity. It's 9 apartments, commercial downstairs, built, tenanted, rented, and it's just a rental share. So again, see the forum, download the documents. Any comments on this one, John, by way of maybe the income angle in the current climate we're in?
Well, 2 things. One is view deal means it gives you an opportunity to view the document in no rush. But then once the project opens, anybody can pledge. So if you do have an interest, I do encourage you to strongly read the offer document, understand what's going on. As an example, a little quiz question for the audience. Figure out if Tranche 1 gets paid before Tranche 2. So read that information. Should all be covered. If it isn't, go to the forum and just post your question and let the developer respond to the question. When it comes to income, 12% net. This is after essentially operating costs and things like that. That's a pretty strong target return. There's no guarantees in these things, but if that's achieved from what is essentially a buy-to-let type investment in a Metro London location, that would be above the norm for London. So do take a look at the document, understand the risks involved, understand the prioritization, and then make your decision.
Excellent. Thank you for that. Okay, let's just get into this week's topics then. we like to keep things real, and the reality is that while we would always love to be in a market that's ever increasing upwards, that is not the reality of property. And certainly the current climate is certainly indicating that there may well be a little bit of a dip in house prices. How low that goes, only time will tell. But I thought it would actually be worth sort of just deep diving a little bit into the whole concept of a house price crash that gets talked about. Is that even a phrase that's relevant? But really, John, I wanted to use this as one of the Ask John segments. You've obviously had a long property journey. When did you first get involved in your first property again?
1983.
83, I was going to say, I knew it was 80. So 1983 to 2022. That's certainly an interesting investment journey. So who better to sort of pick their brain than your good self, John. So I suppose first of all, we're talking about house price crashes. I mean, is that just an emotive, sensational headline? And what really happens to be called a house price crash?
It's like a tree falling in the woods. Most people never hear it. Other than newspapers and other publications like to write it up because it's a very emotive topic and it causes lots of people to chatter about it. But if you think about the last house price crashes we've had, most people had no direct impact. It's like, I heard it. It was in the press somewhere, but can't see it around here. Now, that doesn't mean that the houses on your street didn't go down in value, but if no one on your street sold, nothing changed.
Interesting. So it obviously, what you're saying is the wider society, it doesn't really impact. Obviously, if you're in the property game as a developer or as an investor, it then has an impact to them.
Well, no, not quite. Almost. So if I'm not buying and selling during, quote, the crash, then how would I know anything happened other than the press? If I'm a developer and I have to sell 10 units that I just built and prices are down, that has a very big impact. But it also means if I'm an investor and I'm buying them at a discount. So possibly the long-term investor wins and the short-term investor is the one that gets most likely gets hammered. Ultimately, though, 90-something percent, 92, 93, 94% of the properties never change hands in any 1 year in the UK. So if it never changes hands, did it actually change value?
Yeah, just repeat that figure again. I think that'd be good to have on the recording.
Like
what percentage of house prices?
93%. You can look this up, and it varies based on each thing. And but classically, about 7% of the properties change hands in any 1 year. Even if that number is not terribly accurate, the point is the vast majority never change hands. So if we have a crash for a year or two, and it's 7% a year, and generally sales do drop, so then maybe it's not even 14%; it's maybe 10% of the total inventory changed hands. The other 90% never changed hands. So did it go up or down? Well, if I don't sell it, I don't know.
Okay. Well, just to tease it out slightly in terms of again, who is impacted. If in a rising, I remember back to, 04, 05, 06, 07, when house prices went through the roof, particularly in Northern Ireland, there was an exponential growth coming out of the Troubles. So there was like this feel good factor, and our increase was incredible. Came to what was genuinely a house price crash in 2008, 2009, probably about maybe upwards of 50%, 55% of value disappeared almost overnight. But in terms of impacted, even if you don't buy and sell, would not say that in a market where you can't dip in to use some equity to renovate the house and go on holiday and things like that, would it have a wider impact on the economy?
Well, I would almost argue that refinancing, dipping into the equity is similar to selling. You're recognizing the value and extracting some capital. But if you bought in 2000 and you still owned, you probably remember what you bought it and you probably know what it's worth now. What happens in between doesn't matter. Very similar to the stock market. There are people who look at the prices every day as if that somehow matters to their pension that they invested the money 10, 15 years ago and keep it for another 10 years. So the volatility in between only matters if you're trying to transact. If you're a landlord, and that's why this is focused on landlords, it tends to stay occupied because tenant demand goes up during house price crashes. Because all the tenants who might want to be a buyer say, "Ooh, don't want to buy with markets going down. We hate buying on sale. We want to wait till the prices are up. We pay full price. So in the meantime, we're going to pay the landlord."
Yeah, yeah. I'm just noticing the question there, which actually is
Mhm.
a little bit similar to what I had in my mind. So my comment was actually made before I read this question. This
Mhm.
gentleman actually was at the event last night with a good chat.
Get to the question.
Sophisticated investor. He asked the question, presumably, if property prices drop, that will also affect buy-to-let investors and others trying to take equity out by remortgaging, and also have a wider economic impact due to people spending less. I think that's a relevant point.
Well, there's 2 points there. First of all, most investors, or I wouldn't say most of us, investors are more prone to want to take money out. A lot of the people who own property just sit on it, they live in it, they pay down their mortgage. Their goal is to pay off the debt. So they're not trying to extract value at any one time. Death, divorce, family changes, so life events triggers when they sell, maybe when they extract equity for retirement, medical, whatever. Then when you flip it around, yes, so a house price crash doesn't necessarily affect the economy, or the economy doesn't necessarily affect house prices. It's a bit symbiotic that they both happen at the same time. So turbulence in the economy will cause values to move up or down, will cause people to spend less, pull back, go forward, whatever they want to do. All this stuff happens. I like to draw the analogy, it's the weather. So if it's raining, will you get wet if you go outside? Well, probably. If you bring an umbrella, you wear a trench coat, you're in a bus or a car or something, okay, you're probably not going to get so wet. Is there localized flooding somewhere? Probably. Maybe it's a big puddle, or maybe it's actually no, there's a big river or that floods its banks. So don't see it as binary. Oh, it's happening, so therefore the world stopped. What's happening is a change in the weather. You adjust to the change. As I said, when house prices crash, tendencies tend to go up. People stay longer. They want to rent longer, and they don't buy. When values go up, landlords start to see a drop in income or a flat line in income because tenants move out. Some of those tenants become buyers. So landlords win when the prices are rising, landlords win when the prices are falling. You either get better income or you get better asset value. But your job is not to trade. Your job is to just continue holding on, or whatever the British phrase is for just, muddle along.
Mm. And then it's fair to say that in a situation where potentially there's going to be a down value of property, call it a crash, whatever the terminology you want to use, um, probably looking at your strategy and just making sure your strategy fits with the current economic climate is important. And you just can't go blindly forward if your strategy clearly is going to be impacted by a falling market.
You should always be aware of your strategy in the wider climate, but a landlord strategy is a 20-year strategy. So climate change matters, but not the weather. So focus
Yes.
on the things that really matter over 20 years. Would you want to own this same property 20 years from now? Is it well located? Is it well served by transport? Does it attract people that have jobs and can afford to pay the bills and all the rest? Is it well insulated so that it'll be economical to operate, and tenants will want to live there, whether you're paying the heat or they're paying the heat? So those things matter. But what the value is this week, next week, a year from now, that matters a lot less.
Yeah.
And think of
So
it,
I've actually
and
the reason, just to hold that thought, the reason I jumped off there for a second was I went and picked up a slide from the presentation last night. Obviously, all our slides have to be approved, but this was approved for the presentation last night, so I'm confident Sharon aren't gonna have any issue with using it. But it's actually something you talk about a lot, which you've just talked about, and that is you gotta have the long term mentality. You talked about 20 years there. Used this
Mhm.
slide last night talking about uncertain market. That's almost like exactly what you were talking about a minute ago, John. I know this is one of the things
Mhm.
you do talk about a lot when you're doing presentations, either live or online. You got to stop looking at just today. You got to be thinking long term. So there's house prices in the UK since 1984. Yeah, feel free to dissect
Well,
that and give some pointers.
This in particular plays well to long-term strategies. If you have a short-term strategy, which any developer is a short-term strategy, so you're going to come to market with your finished product, and you're going to have to suffer whatever the market's willing to pay. And if the market's strong, great. And if the market isn't doing very well, then you might have to cut your losses. So if you want to have success in the property market, find a way to extend the curve, find a way to ride the curve. A lot of this change, though, what you have to understand is it's not necessarily that the house has gone up in value, it's that the pound sterling has gone down in value. If we had a 2% inflation rate every year, and let's pretend we did, that means every year it's going to take 2% more of those funky things called pound notes to buy the same property. If you then also have an overlay of a shortage of housing and a rising population, and we're not keeping up when it comes to building, then those same people with their pound notes might actually want to overpay, pay a bit more so they can get to the front of the line to get the house they want. So this curve reflects both of those, decreasing value of the currency and increasing value because of supply demand. If this was a flat curve, say I had 10 properties completely flat for 30 years, but my tenants volunteered to pay all the maintenance costs, all the operating costs, and they paid off all the debt over those period that I owned it. Well, it's not such a bad thing to have 10 rental properties that used to have a big loan, and now all the loans are paid off by those tenants.
Yeah.
And that's the other way to win, that you don't have to have a rising market. You don't even have to have any inflation. And you can win if the tenants say, look, I'll trade you my money for you letting me live in this. Give me a roof over my head from the inclement weather and all the rest. And in exchange, I'll pay off your debts.
Yeah. I think that's a great point. Yeah, I think that's a great point you make, John. And again, sometimes overlooked in the fixation over the price and value of property. The simple reality of having an asset that has no loans against it, that's bringing you in income. I mean, that's the holy grail of investment, if ever there was one. You have an asset, it's unencumbered, and you're receiving a rental income. I mean, like that's exactly what you want. So, yeah, okay. So, any last thoughts then on just this whole idea of a price crash? Again, resisted the temptation of bringing a big crystal ball up
So
for you, but what any thoughts
well,
on the
the
next?
best part of a house price crash is what other people think, and there'll be gloom and doom. So if you're a buyer, this is when you might get a bargain. Now, to find a true bargain means to focus on an individual transaction, understand the motivation of the seller, understand the motivation of anyone else involved in the deal. You get your best deals from motivated sellers where they need to be out of the property more than they need to get best value. And your opportunity is to give them what they need, the cash, in exchange for what you want, which is the property at a good price. So in a gloom and doom situation, there are more motivated sellers. There are more individuals. It's like, okay, fine. I'm going to throw the towel in. I'm going to this one's lost. It's time to move on. Getting divorced, having more kids, need a big house, whatever their trigger is. Focus on that in a down market and you'll get better deals. And then over 20, 30 years, that'll be a better investment. Ultimately, though, location's the key. If you buy in bad areas, you're going to get tenants who aren't happy to live in those areas. You're going to have people that want to buy it from you later. The value is not going to be there. So focus on location and then work a deal.
Location. That's
That's
why
right.
it's such the mantra in property investment. No, absolutely fantastic. Thanks very much for that, John. Some really good insights and points in that. I mean, I mentioned this last night. When you look at say 1984, you look at there's the wars that have happened there, the crashes in the stock market, and the pandemics. All of those are nothing new to history. Those things have happened repeatedly. And it's seeing this, as I often say, as a long-term game, realizing that the fundamentals need to be in place in the market you're investing in. But if you understand the fundamentals, understand time, understand the factors that affect short-term and long-term, then property is a good business to be in my opinion.
Yeah, well, I want to narrow it down. Residential property. So the curve wouldn't look like this for commercial property. Doesn't mean commercial is bad and residential is good. Just you have to understand that the behavior of residential is dictated mostly by owner-occupiers. The majority of residential property in the UK is owner-occupied property. Therefore, their choices dominate the market, and that's the curve or the wave you're riding.
Yeah. And one last point actually as well is this is obviously for instance, across the whole of the UK. Individual regions, the graph could look a little bit different. So if we were to take Northern Ireland, for instance, and yes, we had this unbelievable sort of rise from 2000 right up, but then our dip was significantly more than the average in the UK in terms of where the prices went to, before recovering. So we're still behind the national average in terms of value of house price, even now. So yeah, you've got that nuance as well. So listen, absolutely fantastic. Again, just obviously myself and John are not attempting to give any financial advice or investment advice to anyone. This is just a discussion around the property market in general. So just to make that
Hey,
point.
you brought that up on that. It says real house prices. Does that mean it's inflation adjusted?
Yes.
Okay,
Correct.
so there's no effective inflation in this. So the curve would even be higher if you didn't sort of dampen it down because of inflation. So
yes,
very interesting. Yes. This is the real growth. And if you bought in 1984 and you did nothing other than keep a happy tenant by keeping the property maintained, look at the value that would be created, and you don't cash out, so it's not money in your pocket, but it's not a bad way to grow your pension, so to speak.
Yeah. Brilliant. Okay, well, listen, just wrap it up then. Next week, we haven't done this actually for quite a few months, John. We're going to have a real life property journey story. Mark is a really interesting guy. He's actually a practicing barrister. Again, was at the event here last night, and he has a project on the platform currently. But next week will be primarily just about his journey into property. So it's like, as I asked him last night, how does a practicing barrister become a property developer? It's not a common a common sort of two jobs or two lives. So he's a fascinating story. Really switched on guy, passionate about property. But I think John brings his sort of legal background into how he does his property, which I think is quite fascinating. So he's a brilliant story, and yeah, we're going to have Mark on next week. So looking forward to that. And that is us this morning. Thanks everyone once again for joining. Again, the broadcast will be on our YouTube channel within about an hour. You get us there on youtube.com/Leo crowdfunding. And again, just to conclude, John, I mean, okay, there's only 2 or 3 people, but again, the feedback, the people who come up and like listen to your podcast, listen to the recording, really find it interesting, really find it valuable. I learn so much. There's really good feedback from people, and that's really what this is about. It's about having a library of recordings on a channel where people can see the topic for that week. It may be relevant to them. They can dip in and hopefully get some insights and learn some things.
Yeah, I mean, for people listening, just go to YouTube and search for Leo Crowdfunding. You'll find the back catalog about 2 years worth. And also, David, what's this thing about a podcast?
Yeah. I obviously announced this a few months ago, and we've been sort of working behind the scenes on it. So summer got in the way, as it tends to do sometimes in business. But as John laughs ironically, so
summer got in the way, like
I think you made the
wasn't
comment.
planned for.
Yeah, I think you made the comment that was it until you've done 100 episodes, you're not really a proper podcaster. Is that was your comment? I think. Yeah, we still haven't got number 1 yet, but we're getting there. We're getting there. But yeah, we're gonna kind of if you like, evolve this weekly broadcast into a funding podcast, where again we can spend a bit longer deep diving into this. So imagine, John, if we had an hour to discuss what we've just discussed there in about 16, 17 minutes. I think that would be hugely valuable to people. So the idea is we will pre-record a number of them and release them probably on a bi-weekly basis. And therefore there's a better library getting built. So this broadcast weekly will evolve into a podcast.
So just so we're clear in British English, bi-weekly, is that fortnight or is that a twice a week?
Bi-weekly is a fortnight, every other week. And listen, through time we might get to every week, but let's take one. Let's get the first one done first, and then we can
yes,
and then we can talk about how often they come out. But yeah, and again, but where I'm situated now, in the PLMD offices, they've sort of created a bit of a podcast studio. Other podcasters are now using this studio. So yeah, this gives us a nice base to work from, and yeah, I'm looking forward to it. I think let's just evolve this broadcast, which is cool. So with that, we'll thank everyone once again for being here, and we'll tune in next week and see us all then. So have a great rest of the week and great weekend. Talk to you next week, everyone. Bye bye.
Bye bye.